Hello everyone, today we'd like to present to you Heineken's internal and external environments with the hope of discovering Heineken's major problem and then providing the company with solutions and recommendations to address it. Here to discuss this with you are 5 of Equilibrio's finest consultants, myself Lakshita, then we have Daniela, Ben, and then following Jispel and Kaylin. In this slide, we'd like to show you a brief overview of today's subject matter. Now, to start us off, I will be discussing with you one of Heineken's most critical business level strategies, differentiation. First and foremost, Heineken uses differentiation as its most essential strategy. Heineken expresses this strategy through 5 business priorities. 1. To deliver top-line growth, and then drive end-to-end performance. 3. Brew a better world, and engage and develop people. And finally, connect in a digital world. Through the Brew a Better initiative, Heineken successfully distinguishes itself from the competition as the industry leader in sustainability efforts. This goes from using electric trucks to deliver Heineken products to its latest co-branding venture with Formula E, where the racing cars are battery-powered with zero emissions. It is clear that Heineken seeks to separate itself from the rivals by being modern, sleek, and environmentally friendly. In addition, these ventures play an important role in Heineken's brand equity, as the company invests heavily in moment marketing, especially as it relates to sporting events and in-movie brand placements, like in James Bond. This helps consumers resonate well with the brewery's desire to be a part of the fun and special times that they go through. In turn, these positive experiences lead to viral and word-of-mouth marketing. Altogether, these company practices show that Heineken has successfully separated themselves from the competition. Next, Kaylin will take over to highlight another core business level strategy, cost leadership.
Thanks, Madhu. Along with differentiation, Heineken also uses cost leadership as a core business strategy. When executed effectively, a cost leadership approach will lead to numerous benefits, especially for a company with extensive global operations, such as Heineken. I'd like to kick off our review of Heineken's cost leadership by looking at how the company implements and benefits from this strategy. A predominant way Heineken executes cost leadership is by acquiring major breweries in key regional markets. Having a large international supply chain allows Heineken to have a greater global reach. This reach grants the company greater bargaining power with suppliers and enhances their overall economies of scale approach. An innovative way Heineken implements cost leadership is through its sustainability practices. Surprisingly, Heineken's focus on environmental sustainability through its Brewing a Better World initiative has led to significant long-term cost savings. In fact, in 2015, Heineken reported a savings of roughly $84 million through these practices. Now I will pass it over to my partner Daniela, who will talk about Heineken's mergers and acquisition strategy.
Thank you, Kaylin. A major corporate strategy that Heineken uses is mergers and acquisitions. A notable acquisition was in 2015 between Heineken and Lagunitas Brewing Company. As the 9th largest brewing company, this Californian craft brewery sparked Heineken's attention because of their market share, their unique craft beer, and the ability to further distribute overseas. Heineken acquired 50% of Lagunitas, and this deal is valued at over $41 billion. Next, Heineken acquired Brasil Kirin in 2017. Brazil is the 3rd largest beer-consuming country after China and the US, so it made sense for Heineken to enter this market. They acquired their assets for $704 million, but its value increased to $1.1 billion when the two companies consolidated. Currently, Heineken operates with 12 production facilities with its own distribution network in the Northeast region. Overall, Heineken relies on this strategy to expand into markets, diversify its brand, build consumer awareness, aid local companies, and overall generate profitability. Next, Ben will talk about the international strategies of Heineken.
Thank you, Danny. Vertical integration is a finer, more distinct form of Heineken's larger M&A strategy. Based on the company's recent M&A activity, Heineken engages in both forward and backward vertical integration. In regards to Heineken's backward integration, the company's long-standing history of owning breweries and packaging facilities has given the firm high proficiency. In fact, Heineken's mastery over backwards integration is what primarily allows the firm to reduce costs. Furthermore, by purchasing vendors that conform well with the company, Heineken continues to synergize its supply chain to enhance its global reach. With that being said, forward integration is a relatively fresh tactic for Heineken. This strategy is best exemplified in Heineken's 2017 acquisition of Punch Taverns, a UK pub group that owned about 1,900 bars and restaurants. This acquisition allows the company to further penetrate existing markets by exclusively placing Heineken and subsidiary product lines into those retail channels. Additionally, forward integration prevents rivals from targeting social drinkers, an important subsection of beer consumers who only consume alcohol in social settings. By being the exclusive beer provider at a social venue, these consumers are more likely to develop a long-lasting connection with Heineken, and perhaps prefer it going forward. Vertical integration builds on Heineken's core competencies and strengths in a way that sustains competitive advantage. This is especially true against smaller competitors who lack the ability to attempt this strategy. Now, let's transition into looking at Heineken's competitive environment. By looking at Porter's 5 forces model, we're better able to understand and address Heineken's pressure points. To do this effectively, we've decided to focus solely on Heineken's high-level threats. Let's start with Heineken's degree of rivalry. At this time, the beer industry is remarkably competitive. Breweries have to compete on several dimensions, such as price, quality, brand recognition, and distribution channels. In order to thrive, breweries can't simply produce a product that tastes good. They have to offer products that resonate with the target consumer's lifestyle. This leads me to the threat of substitutes. For a long time, beer was the most popular alcoholic beverage, but lately, US consumers are gravitating towards substitutes. Because of this shift and the high amount of substitutes present, Heineken is seriously threatened by this force. For instance, research shows US consumers are choosing to drink more high-end wines and spirits than beer. Furthermore, carbonated alcoholic beverages like White Claw hard seltzer have become tremendously popular in recent years. Let's discuss the threat of new entrants. Naturally, consumers are eager to try new beers and alternatives to beer, which means the beer industry has relatively low brand loyalty. This suggests that the threat of new companies entering the industry is always present. With that being said, the high initial investments needed to create an international brewery may lead you to believe the beer industry has a high barrier to entry. However, with the newfound presence of microbreweries, who mostly focus on creating high-quality craft beers for local and regional markets, this is actually not the case. This makes business challenging for Heineken, because consumers are intent on trying different beer flavors, brands, and breweries. When fully taken into consideration, these competitive forces indicate that both the beer and overall alcoholic beverage industry are severely oversaturated. This leads us to Heineken's SWOT analysis and major problem, which Giselle will discuss. Thank you.
Thank you, Ben. I will now go over a SWOT analysis for Heineken in the US market. The strengths are a large brand portfolio, great corporate responsibility, and a strong supply chain network. This is very important, especially for the US consumers. Some of the weaknesses are a weak brand association with millennials. This is important because millennials became the largest beer consumer in the US market. In addition, the company had a slow response rate to changes in the industry, which in turn affected Heineken's overall performance. Some of the opportunities Heineken has are investing in healthier beer options, which is something millennials are very aware of, as well as expanding by acquiring small breweries and companies that will add to the portfolio of Heineken and will increase the amount of products Heineken can offer to millennials. Some of the threats are an aging target market, which can be seen as baby boomers grow older and are no longer the target consumer for beer, as well as the regulations that the government imposes, such as drinking age. With that being said, I will now explain the main problem Heineken is facing: a stagnating industry. A stagnating industry is when the economic curve plateaus and there is no growth or advancement within the sector. This has been happening to the beer industry for the past couple of years. Business stagnation has affected big breweries who focus on offering premium beer products such as Heineken and its competitors Coors Light and Budweiser. There are different reasons why the beer industry is stagnating. It could be because of the high degree of rivalry, like my partner Ben explained, low consumer brand loyalty, or an increase in available substitutes. Nonetheless, the most important is the shift in consumer preferences across the United States market. The shift in consumer preferences is mainly due to the fact that millennials became the largest generation in the US market in 2019. The target consumer for beer used to be a middle-aged white male, but now that has changed to being millennials of both genders. The beer industry suffered stagnation because it was not able to rapidly adapt to the new changes. The main issues that the industry has to address now are the fact that millennials use tobacco and narcotic products as a source of pleasure and entertainment. The beer industry must be able to capture the millennials' interest again and meet their needs so that they incorporate as much beer into their lives as baby boomers did, who were the previous target consumer. In addition, millennials have a desire for healthier alternatives to beer. This includes alcoholic seltzer waters, low-calorie beers, and more flavorful alcoholic drinks. In order to meet the millennials' needs in this regard, Heineken must adapt to these new preferences. I will now pass it on to my partner, Kaylin, who will speak on the effects on Heineken's financial performance during this period of stagnation in the beer industry.
Thank you, Hizbel. As we know, Heineken is the number 2 beer brand in the world. By assessing the company's financial health, we can provide a clearer way to move forward with the strategy. Heineken's previous quarter showed a strong balance sheet, proving its financial stability in a stagnating industry. Focusing on the U.S. market, Heineken remains a small player, owning only 4% market share. With continuous developments on COVID-19 in the U.S., the future remains unsure. One thing we would like to point out is a stock price drop beginning in the quarter 1. We attribute this price drop, shown by the red arrow, to the decline in consumer consumption within the first few months of the quarter. However, the latter part of the quarter was the beginning of the pandemic, causing plummeting prices and creating lower lows. Beer volumes fell by 14% in the industry, and Heineken saw a 2% decrease, which is better than what analysts had predicted. With the release of their first quarter trading report, Heineken has been forced to change their financial outlooks, which has set a bearish tone, according to analysts, for rivals Anheuser-Busch and Carlsberg A/S. Heineken also announced that they are expecting a worse second quarter, expecting a drop in demand due to the pandemic. The company's biggest concern now should be how they can stay afloat in these changing times. Even though the company shows financial health and stability on paper, market conditions for industry stagnation have been prevalent for quite some time. Heineken and its competitors are expected to follow this declining trend in the industry. Let's take a look at Heineken's performance in the U.S. Here, we can see Heineken compared to its top 2 competitors in the U.S., Anheuser-Busch with ticker symbol BUD, and Molson Coors with ticker symbol TAP. The percent changes have been below 0. Within the last month, after the company's release of its trade report, we saw Heineken keeping a steady fluctuation in its price as opposed to the quick rallies in both Molson Coors and Anheuser-Busch. Since Heineken has such a small market share in the U.S., the closings of bars and restaurants, which is where they get the most part of their profit from, have hurt them the most. Anheuser-Busch and Molson Coors have been able to rally because they have a higher market share and also because they have been entering the new spiked seltzer trend in this market. To succeed in the U.S. market, especially during these times, the company should be focusing on understanding trends state by state, as proposed by CFO Lawrence DeBro. Now that I've given you some information on where the company stands in the U.S. market, my colleague Danielle will present our recommendation for you all.
Thank you, Kaylin. We recommend that Heineken uses its core competencies in differentiation, cost leadership, and efficient operations to adapt to the changing target audience as well as engage with millennials. Our proposed first course of action focuses on revamping Heineken's U.S. marketing strategy through delivery co-branding and active advertising. The coronavirus pandemic has impacted consumer purchasing power and shopping habits, where 74% of consumers are shopping online and having those essential needs delivered to their home. Liquor stores and supermarkets are considered essential businesses during the time of the pandemic, and customers have been taking advantage of this. Due to the stress of the pandemic and its accessibility, online sales of alcoholic beverages have increased to 243%, and beer sales have increased to 42%. With this increased consumption, it can be said that this is an opportunity for Heineken to target consumers by staying at home and providing their products straight to door. Our first course of action puts in place a direct-to-consumer platform partnership with leading delivery services such as Grubhub, DoorDash, Seamless, and Uber Eats. Heineken can utilize these platforms because during the national lockdown, these companies have still been able to deliver food and beverages to consumers. In order to advertise this opportunity, Heineken should run advertisements showcasing this new service with the message #HeinekenAtHome. Heineken can also offer special discounts for essential workers and run digital ads that aim to celebrate the frontline workers and continuously push the message for responsibly staying at home. The benefits of direct-to-consumer partnerships stems from expanding brand recognition, improving customer engagement and interaction, as well as making our full portfolio available online. After returning to a new normal, these partnerships would continuously stay in place for future at-home deliveries. Next, Madhu will explain our second course of action.
Thank you, Danny. Our second course of action focuses on acquiring White Claw through horizontal integration. As previously mentioned by Danny, Heineken has a long-standing history of acquiring other brands. Therefore, we think it's best for Heineken to acquire White Claw, which is a low-calorie, low-carb hard seltzer with only 5% alcohol. We believe that White Claw is the ideal acquisition for several reasons. One, it's a gender-neutral drink, currently targeted at young millennials. As Giswell mentioned, young millennials are more health conscious than previous generations. Therefore, White Claw would be the perfect product line extension for the firm, mainly due to its health priorities. To further boost commercial appeal, White Claw is available in a wide variety of flavors. But most importantly, White Claw is responsible for 50% market share within its current US seltzer market, with a total valuation of approximately $3.4 billion. To further justify this acquisition, we analyzed Heineken's product lifecycle. As we can see here, Heineken's products have mostly reached maturity stage in their product lifecycle. This is not inherently a concern for Heineken as the company is still experiencing the peak revenue figures. However, as the prolonged stagnation of the beer industry continues, along with the current fall in beer demand associated with COVID-19, we suspect that these market forces may trigger a decline stage for Heineken's products. And this is the reason why we want Heineken to acquire White Claw to combat this stagnating industry issue. White Claw's suite of flavorful products would refresh Heineken's product lifecycle while the company's core products continue to age. This would create a seamless transition for the firm as White Claw and Heineken both have established a relatively loyal customer base. Additionally, this acquisition and partnership would enable Heineken to use its powerful global supply chain network to push the products into a variety of global markets, while further penetrating the US market through the intercompany synergy, and the White Claw brand could experience exponential growth. In order to market the product line extension, along with other Heineken products, it would be essential to reposition the brand. As you can see in this perceptual map, the red star portrays where Heineken can reposition itself to target young millennials, while continuing to differentiate itself from the competitors. To push the marketing strategy, it would be essential to understand key customer touchpoints. Based on Ublero's statistics, there are over 3.5 billion social media users, and over 90% of the target millennials are using social media on a daily basis. Therefore, a social media strategy would be ideal and cost-effective. A possible social media strategy would be to repost fan-made memes of White Claw products on Twitter, Facebook, and Instagram. These are the most popular sites where traffic comes from to the White Claw website. Speaking a little bit about the competition, the three main competitors are Anheuser-Busch, Corona, and Coors, as these brands have also entered the seltzer market. Yet Heineken has a very clear competitive advantage, which is the fact that they own 50% of the market share and they also have a strong brand equity. At a $3.4 billion valuation, White Claw is by no means a cheap investment, yet the benefits of acquiring it far exceeds the drawbacks. It would be the perfect acquisition for Heineken to uptrend in this stagnating industry. Next, Giswell will take over to conclude.
These two courses of actions were created to keep in line with Heineken's overall competencies in cost leadership with differentiation. By highlighting the company's key strategies, 5 forces, SWOT analysis, and an overview of the financial health, we were able to determine a major problem that the company is facing and provide a reasonable recommendation based on these points. We hope you take our recommendation into consideration, and we thank you very much for your time.